Did you know that the average investor actually underperforms the market? It's a sobering statistic, highlighting a truth many refuse to acknowledge. Timing the market, especially trying to buy the dip, is far more difficult than it seems. The allure of snatching up undervalued assets during market downturns is powerful, fueled by the promise of significant returns. But what if this very pursuit, this relentless chase after the perfect entry point, is actually hindering your financial growth? Welcome to Grow Financially, where we equip you with the knowledge and strategies to build lasting wealth. Don't forget to subscribe and let us know in the comments below. What's one common mistake you see investors making when attempting to buy the dip? Your insights could help others avoid the same pitfalls. The buy the dip strategy, popularized through countless online articles and financial gurus, paints a picture of savvy investors effortlessly capitalizing on market corrections. The reality, however, is far more nuanced. This approach rests on the premise of accurately predicting the bottom of a market downturn, a feat that even seasoned professionals struggle with consistently. The timing is crucial. Buy too early, and you could be stuck watching your investment plummet further. Buy too late, and you miss the opportunity for substantial gains. This inherent uncertainty introduces a significant element of risk, potentially eroding your portfolio's value rather than enhancing it. The psychological pressure associated with timing the market adds another layer of complexity. The fear of missing out, FOMO, can lead to impulsive decisions, pushing investors to buy at inflated prices or hold on to losing investments for too long, hoping for a rebound that may never materialize. Conversely, the fear of further losses can paralyze investors, causing them to delay purchases even when the market presents attractive opportunities. These emotional responses frequently override rational judgment, leading to suboptimal investment outcomes. Instead of focusing on the elusive dip, consider a more sustainable, less emotionally charged approach: consistent, disciplined investing. This strategy prioritizes regular contributions to your investment portfolio regardless of market fluctuations. Whether the market is soaring or plummeting, you remain committed to your investment plan, accumulating assets steadily over time. This approach reduces the impact of short-term market volatility, allowing you to ride out the ups and downs without succumbing to panic or impulsive reactions. The beauty of disciplined investing lies in its simplicity and effectiveness. It eliminates the need for market timing, freeing you from the stressful guessing game of predicting market trends. It also encourages a long-term perspective, aligning your investment strategy with your overall financial goals. By consistently contributing to your portfolio, you benefit from the power of compounding, a phenomenon that amplifies your returns over time. The longer your money remains invested, the more it has the potential to grow. Disciplined investing doesn't mean ignoring market conditions entirely. It simply means not letting short-term fluctuations dictate your investment decisions. While it's beneficial to stay informed about market trends and economic indicators, these factors should not override your established investment plan. Your focus should remain on your long-term goals and your commitment to consistent investing. Regularly review your portfolio to ensure it remains aligned with your objectives and make any necessary adjustments based on your long-term financial plan, not based on short-term market anxieties. Avoid the temptation to react emotionally to every market movement. Moreover, diversification plays a crucial role in mitigating risk and enhancing long-term growth. Don't put all your eggs in one basket. Spread your investments across various asset classes, such as stocks, bonds, and real estate, to reduce your exposure to any single market segment. A well-diversified portfolio offers resilience against unexpected market downturns, buffering you from the impact of significant losses in any one area. This strategy isn't about trying to pick the perfect time to buy low and sell high. It's about creating a stable, robust portfolio capable of weathering market storms and generating sustainable long-term growth. The journey towards financial stability is often an arduous path, sprinkled with challenges and uncertainties. The temptation to seek shortcuts, to want instant results, is strong and often leads us to make wrong decisions based on emotions and speculation rather than solid strategic planning. But the truth is that genuine wealth, the kind that provides peace of mind and security for the future, is built brick by brick with patience, discipline, and perseverance. Imagine the relief of freeing yourself from the constant pressure of trying to predict the market's movements. Imagine the tranquility of knowing your investment plan is on track, growing consistently, even amidst economic turmoil. That is the power of disciplined investing, the quiet force that accumulates wealth over time without the need for financial acrobatics or market predictions. It is the choice of consistency over speculation, of strategy over improvisation. Don't be fooled by the easy promise of buying the dip. This is a trap, an illusion that can lead to significant losses and continuous frustration. Instead, embrace the wisdom of patient and consistent investing. Build a diversified portfolio, make regular contributions, and stand firm in your plan, even in the face of adversity. Remember, wealth is not a sprint but a marathon, and persistence is your most valuable ally. Financial success is not just about accumulating material wealth, but also about building a solid, resilient mindset prepared to face life's challenges. It's about creating a secure future for you and your family, free from financial worries and full of opportunities. It's about the freedom to pursue your dreams without the constant shadow of economic insecurity. Investing in a disciplined manner is a declaration of financial independence. It is an act of faith in your own capacity for planning and perseverance. It is an investment not only in your future, but also in your peace of mind. It is the conscious choice of a slower, but safer and more lasting path. So, leave behind the fruitless search for the perfect dip and start building a solid financial future. Subscribe to the Grow Financially channel for access to more strategies, tips, and insights that will help you on your journey to financial freedom. Share with us in the comments, what is the biggest financial lesson you have learned from your investment experiences? Your testimony can inspire others to tread a smarter path to prosperity. Click on the screen to continue learning about long-term investment strategies and build the wealth you deserve.